Okay, everybody, welcome to the TSP Weekly Update Show for July 17th, 2022. Conan and I are moving in different directions this weekend, so I'm recording the show on my own. I'll be back in Virginia next week for a while, and we'll be back in the podcast studio as usual. It was a tumultuous week for the market, kind of opposite to what we've seen over the past few months. Lately, the market had been trending up early in the week and falling off later in the week. This week, the market trended lower all week and then popped on Friday. So this week, we're going to take a look at sentiment, right? Actually, sentiment versus reality. Sentiment refers to how investors feel, right? Versus what I'm calling reality, which refers to actions that investors take. We have a few sources that indicate investor sentiment, and then we have a couple sources that give us actual investor actions. Sometimes actions definitely speak louder than words. Okay. The bonus chart is $TNX. We've looked at this before. It's the 10-year Treasury yield. We're going to look at how we can use that chart to make reallocation decisions. And then finally, the weekly TSP fund charts. So I found this picture this week and had to share it. It's probably more applicable now than it was back in 2016 when the New York Times first published it. What it says to me is that the market chaos is happening, right? There's nothing we as individuals can do about that. There's all this churning going on all the time in the market. What we can do is not get sucked into the chaos, right? From my perspective, there are really only two ways to stay out of the chaos. The first is to not engage. If you don't mind, it doesn't matter, right? Unfortunately, disengagement is usually not the best strategy if you're trying to actually grow your TSP account. The second way is to see the longer trend through the chaos. We talk about it every week on the TSP Weekly Update Show. The 3-year weekly chart shows us the longer term trend. And if we can see that through the chaos, then we can kind of, stay above it and stay emotionally detached. If you want to dip a toe back into the chaos and try to time the market for a quick gain, that's on you. But at any rate, I really like this picture. Okay, so sentiment. It's a contrarian indicator, right? The idea is that when there's a lot of fear in the market, price tends to be near a bottom. When there's very little fear in the market, price tends to be close to a top. The question is, how do we measure fear, right? And what we want to know is the reality of the fear. Okay. So this is one we've looked at a while ago. It's the CNBC or CNN Business Fear and Greed Index. This is, they call it a fear and greed index. It's actually calculated using a series of different technical indicators. Okay. So they measure, each indicator measures some aspect of stock market behavior, momentum, right? Momentum, stock price breadth, put call options, junk bonds. They use a bunch of really good indicators and kind of average them all together. The index tracks how much these individual indicators deviate from their averages compared to how much they normally diverge. So we're measuring differences here. The index gives each indicator equal weight in calculating a score from 0 to 100, with 100 representing maximum greediness and 0 signaling maximum fear. So if we take a look at the chart of the index over time, last week, as of actually July 15th, we were at a rating of 24, right? It's extreme fear, but it's just barely outside the fear range and into the extreme fear range. So, on the face of it, you would think that based on this being a contrarian indicator, the market should be at a bottom, right? It would be an indicator that the market is at a bottom because at extreme fear levels, the price tends to be at a bottom. Unfortunately, when we look over here to the right side of the column, the previous close was extreme fear. A week ago was fear. A month ago was extreme fear. And a year ago was fear. So at least for the past year, we've been in this section, which would indicate somewhere in there a market bottom. And we did get several market bottoms, only for price to continue to roll over and go to new lows. So can the fear and greed index be useful as a short-term indicator? Probably yes, right? A month ago was the most recent low, and we were at the most extreme fear reading on this. So can there be some value in the fear and greed index in terms of a contrarian indicator on a short-term basis? Yes, I think it probably can. As far as a long-term timing tool, I don't think so. Okay, so that's the CNN Fear and Greed Index, and again, it's based on technical indicators, a compilation of technical indicators. The next one is the AAII. It's the American Association of Individual Investors. So the big thing about the AAII, as opposed to the CNN Fear and Greed Index, is AAII is a survey. Okay, they're going out and asking their subscribers, because you subscribe to the AAII. They're going out and asking their subscribers how they feel about different pieces of the economy, right? So AAII Sentiment Survey offers insight into the opinions of individual investors by asking them their thoughts on where the market is headed in the next 6 months, and has been doing. It's been doing so. It's been doing the survey since 1987. Okay. So it's asking individual investors their thoughts and opinions about where they think the market is headed. That's much different than looking at technical indicators like the CNN Fear and Greed Index does. Okay. So this market sentiment data is compiled and depicted for individual use, right? Investor sentiment is measured with a weekly survey conducted, yada, yada. Okay. So here's what it looks like when they put it all together. What direction do AAII members feel the stock market will be in the next 6 months? It's much different from the CNN Fear and Greed Index, right? On the CNN Fear and Greed Index, we had previous week, fear, a month ago, extreme fear. They don't have it 3 months ago, but it was certainly fear. And then 6 months ago here, and this one is neutral. So while AAII is basically greedy over the same period that the CNN index is fearful. So depending on your source of information, you could come to much different expectations for what's going to happen in the market going forward. So the current AAII sentiment, it's a contrarian indicator. Above average market returns often followed, usually follows after low levels of optimism, right? So it's a contrarian indicator. If we look at the chart, like a more of a stock chart type of look at the AAII, okay? So this chart, it was taken off of stock charts. It's the AAII Bull Index, okay? So it's taken from that AAII survey, put in a chart format, and it's only the bulls. Okay, so only the people in the survey that think the market is going higher. Okay, so it began back here in 1987, and it goes through present, and it's a monthly chart. Okay, so what it tells us is that right here in 2022, we have the fewest number of bulls. Right, less than here 2016, way less than 2008. Less than 2000, right? So if you have a very few number of people here that expect the market to go higher over the next 6 months to a year, it would indicate, since it's a contrarian indicator, that we should be at a market bottom, right? And it's a long-term, this is a long-term chart, and this is as the fewest bulls. So we'll call it the most bearish that this indicator, the survey has been since all the way back here in the late 80s and early 90s. So this particular indicator you would expect that we're at some kind of a market bottom. If we zoom in a little bit and we look at, I think this is a 2.5 year daily chart. Okay, so this part of it is a zoomed in version of that AAII bull index. And I overlap that with the S&P 500. Okay. So you can kind of see the trend of the AAII bull index started to go down. So there were fewer bulls starting back here in November of 2020. The S&P 500 was still rising, right? But back here in November 2020 was actually where the F fund topped out. So the bond index, the AAII was tending to kind of go more along with the bond index than the stock market. But either way, the survey of people that were bullish was decreasing starting back here in November 2020. Okay. So the last one I got as far as sentiment goes is the Michigan Consumer Sentiment Index. So Michigan Consumer Sentiment Index, again, it's a survey of consumers, and it's how people feel about different aspects of the economy. They average it together and put it in a chart format. And so this is the Michigan Consumer. This line is the Michigan Consumer Index. And as you can see, when people are not feeling good about the market is falling. In this case, I overlaid it with the S fund. Okay. So the S fund is below. So when the sentiment indicator is declining, S fund is declining. When the sentiment indicator, people are, not bullish or bearish, right? They're tending bullish, but certainly not bearish. The S fund is climbing, and right, as the S fund starts to level off and sentiment starts in the other direction, the S fund can't move any higher and eventually rolls over. So sometimes the Michigan sentiment indicator is it's a pretty good indicator for telling us kind of the how investors feel, right? Because that's what it's for. It's a survey. It tells us how investors feel. And sometimes it can be a leading or maybe a little bit lagging indicator for prices in general. And in this case, it did a pretty good job with respect to the S fund. Okay. So here, I would argue, is where we step across the line from sentiment to reality. Okay. So the red line in this chart is the VIX. Okay. The black line is the S&P 500. Right. What we call the VIX is the Chicago Board of Options Exchange Volatility Index. It represents the market's expectations for the relative strength of near-term price changes of the S&P 500, which is our C fund, right? So it's derived from options, not actual price. It's derived from options, and it generates a 30-day forward projection of volatility. So when the VIX is high, investors are usually buying a lot of puts, which are a bet that the market will be lower in the next 30 days. When the VIX is low, investors are not buying puts, right? Which indicates that they're not too worried about the market over the next 30 days. And this is why it's generally referred to as a fear index. But the reason this is real versus sentiment is that for the VIX to spike, right? For the VIX to make these big spikes, investors are actually buying puts, right? They're not telling, surveyors that they're concerned about the market 30 days out. They're actually doing something about it, right? Either to protect their portfolio or to make money if the market goes down, because that's what happens when you buy a put. You're betting that the market's going to go down. So this is a chart of action, not sentiment. And it's also a contrarian indicator, right? You can see the spikes tend to correspond with market bottoms, right? When VIX spikes high, it tends to indicate a market bottom. Okay, what it is, as opposed to sentiment, when the VIX spikes, it's people throwing in the towel, right? That's what we're all kind of looking for right now. So what does this chart tell us in the big scheme of things, right? We're looking at back to 2002 to the present, and it's a monthly chart. So what does it actually tell us? The VIX spikes are easy. Okay, they're telling us that people are throwing in the towel. I've had it. I'm buying puts either to protect so that I don't have to sell my portfolio. I can buy puts, so the puts will go up, even though my portfolio is going down. If I buy puts to protect it, I'm making some money as the market goes down from puts, so that I don't have to sell my underlying portfolio. Or they're buying puts, betting that the market is going to go lower and just trying to make money off the puts. Either way, they're buying puts with the expectation that the market is going to go down further. Okay, so a spike in the VIX tends to indicate, because when people really are sure that the market's going to go lower from here, it tends to indicate a market bottom, right? So here they are actually buying puts. They're not telling people they're afraid. They're actually doing something about it. So again, what does this chart tell us? The spikes are easy to see. The consolidations are equally important, right? When we have a spike up in the VIX, it indicates a low. When we have a spike down in the VIX, it indicates a breakout in price, and price tends to move higher. It's these consolidation periods where there's not too much volatility going on, right? Price is moving, but and as the VIX tends lower, the price tends higher. Okay, which is usually the way of things, right? Because usually we're not in these big swings. We're usually in some kind of area where VIX is tending lower and the price is tending higher, or the VIX is tending higher and the price is trending lower, right? So where we are right now, the VIX is obviously trending up, but it's not spiking, right? This is an orderly move higher in the VIX, which corresponds to an orderly move lower in price of the S&P 500. So what we have not seen yet is a spike like this. Okay, that's what a lot of financial planners, wealth advisors, a lot of people are looking for this spike, because that would be when people are throwing in the towel. That's capitulation. That's when there's actually blood in the streets, because you're seeing people actually doing something. They're not just saying they're afraid, they're actually doing something. And we have not seen that yet. We will see it at some point in this correction. We will see some kind of big spike in the VIX, but clearly we're not there yet. Okay. So the last thing about kind of reality versus sentiment, this was from a FedSmith article from February, so it's a little bit old, but it was, clearly after the beginning of the big move lower in this correction, right? Because the very beginning of January is when it started. So in TSP, how would we measure kind of sentiment versus reality? It's easy to see the reality, because it's when TSP investors actually make interfund transfers. So the stock market took a tumble in January. Stock prices went down significantly in 1 month. It generated more interfund transfers in January than usual. Okay, so for the month, more than almost 6 billion was transferred into the G fund, right? About 6 billion transferred into the G fund. Okay, At the same time, 2.4 billion was transferred out of the C, 2.1 billion out of the S, 600 plus million out of the I. While money, this is kind of the important piece. While money transfers in the billions are large, right? As of the end of January, the TSP plan was over 780 billion in total. Okay. So it means that the percentage of TSP assets transferred was relatively low compared to the total assets in the program, right? So if 6 billion went into the G fund out of over 780 billion that's a total in the TSP, that's not a very big chunk, right? It's not a very big chunk of money on a percentage basis versus the 780 plus billion. And it's probably, in terms of the number of people that moved, that did IFTs into the G fund, is probably relatively low, because most people that did do an IFT into the G fund would have transferred all of their money into the G fund, not just some of it. So it's probably a relatively small number of people that did IFTs in January, and they transferred a relatively low number on a percentage basis of the total. Okay. So people might have said they were afraid if they were surveyed back in January, but in reality, very few people moved their money into the G fund. If we fast forward a little bit, this was taken from the Thrift Retirement Board meeting minutes from March. So it incorporates January and February. Okay. So it says participation in the L fund increased in February, which primarily driven by automatic enrollment of new participants. So it's not saying that people reallocated into the L funds. It's saying that because the default now is new employees get signed up and go automatically into the L fund. And they're saying that's probably why we had an increase of participation in the L fund in the beginning of the year. Participants moved an approximate net 7.6 billion into the G fund. Okay, so it is up a little bit from January, because January was 5.8 or 9 billion. But McAfee noted that only 2.2% of participants conducted an interfund transfer in January. Okay, so almost 98% of participants did not conduct an interfund transfer. So still, a very low number of people are actually doing something with their money to protect it. Okay. So through the first 2 months of 2022, just under 4% of participants conducted an interfund transfer. And if you go back and look at the actual meeting minutes or are on these calls, we talked about them last week or the week before. The calls are available to the public. I think it is the fourth Tuesday of every month at 10 a.m. And I had put out that information. It was either last week or the week before, when we went over what the Federal Retirement Thrift Investment Board actually does and their briefings about the new TSP.gov fiasco. Anyway, a very small number of people have actually done IFTs. And on the call last week or earlier this month, they said that the average across time is 2% of TSP investors on any given month make interfund transfers. So to have 4% over the first 2 months of the year is average. And so what it's telling me is, while people might say that they're afraid, they're not showing it by moving to the G fund. So how does that correspond to the VIX chart, right? We have not seen this spike. At some point, we're going to get TSP investors that throw in the towel and say, that's it, I'm out. And then, a month or two later, we'll hear on this Federal Retirement Thrift Investment Board call that this number, the percent of participants that conducted an IFT, will spike, to what? If the average is 2%, maybe it's 4 or 5%, but it'll be some kind of spike, and it'll correspond with a spike in the VIX. Okay. Hopefully that gives you guys a little bit of an idea of how we can use sentiment and the difference between what people say, how people say they feel, and what people actually do, what actions they take to protect their investments. Okay. So the $ TNX, this is the 10-year US Treasury yield index. And we're going to go back to March of this year. So it's a 6-month chart. I pulled it up. Basically, I have this chart in my slide deck. I look at it every day because here's what it does for us. When the yield on the 10-year Treasury is increasing, the price of bonds is decreasing. Okay. So right now, the yield trend is down. And so when yield goes down, the price of bonds goes up. So I drew this trend line, right? And I made a note for myself because if I'm in the F fund, the AGG, if the yield gets up here, so if the yield starts rising, it means the F fund is falling. So if the yield gets above that trend line, I want to get out of the F fund if I'm in it. Okay. When the yield goes down, it's bullish for the stock funds. So we have a lot of support here at this 27 level, right? So if yield starts coming down and gets below 27, I want to look to get back into the stock funds, into actually the growth stocks, right? So personally, I'm looking at this for ARKK, which is very, very volatile growth stocks. But in terms of TSP, that's when you're looking to get back into, for example, the S fund. S fund is our version of small caps. It's the best we can do as interest rates start to come down. So if interest rates come down, get below 27, that's going to be one serious indicator to get back into the CNS funds. All right. It's a really useful chart. Hopefully you guys take a minute to look at it and let it digest because it's one that I look at every day. All right. The TSP fund charts, not much has changed. As you can imagine, we've been looking at this chart here for months and months at this point. And it kind of goes back to the picture we were looking at in the beginning. If you want to stay above the chaos, this is the chart that's going to help you do it. Back here was the low in COVID. Once price got above its 20-week moving average line, right? 20-week moving average line is this blue line. Once price got back above it, every time we had a little correction, we got support at that 20-week moving average line. So the chaos is going on. This is all the chaos up here. But the trend is that 20-week moving average blue line. So we got support all the way along until January of this year when price broke down through it on a weekly basis. And then ever since then, it can't stay back above it. So until that blue line turns positive, which means price is back above it, there's no point. Well, I won't say there's no point. The trend is down. And the trend continues down until it turns and goes back up. So there's all kinds of people that are prognosticating about, how low the market can be. There's an argument for 3,400. There's an argument for 2,400, and it could go lower from there. There's arguments for everything in between. I don't really care about all that. I mean, I look at it all, but what I actually care about is what the market does. At some point, and maybe this is the low, who knows? At some point, price is going to come back up and get above this downtrending blue line. Once that happens, then it's the beginning of a trend change, right? That's the first indicator that something different is happening, and that's it. We'll get to that when we get to it. But for the time being, the trend is clearly down until it's not down. And one of the indicators we use to support that is the relative strength indicator. Okay. once price got back above the 20-week moving average line and the relative strength indicator got back above the 50 line, price was going higher, right? So as long as we stay above that 50 line, we're in good shape until we break below it. As long as we're below that 50 line, we don't want to be in the stock funds. Okay. Same thing for the S fund. Once we got back above that 20-week moving average line, we stayed above it until January. The S fund was until November of last year. Broke down through it. Ever since then, couldn't get back above it. S fund clearly is in a downtrend. Until the trend changes, no point in being in the S fund. And we have been below that 50 line since November. So until we can get above that 50 line on relative strength, no point in being in the S fund. I fund, same kind of thing. We broke out above it back here after COVID. Got above 50 RSI. Stayed there until, I guess I would argue for the I fund, it was back here in November also, kind of like the S fund. The shape is a little bit different, but the result is the same. We're in a downtrend until we're no longer in a downtrend. And so that's what it is. The F fund is kind of the most interesting chart we have going on right now, I think. We have a high back here in the middle, what was that, July of 2020. That was the high of the F fund, and it was an historic high. Since then, we have come way, way off. This is the low from COVID, and we're below those lows now. So there's a lot of talk about the bond market. People are expecting, everything is in the market where price goes is based on expectations. And at some point, the Fed, which has been raising rates here for the past 6 months, is going to have to what they call pivot. And it's going to have to lighten up, because as the economy goes into recession, the only tool that the Fed really has is to raise and lower interest rates. And so if the economy is in recession, at some point, the Fed is going to have to stop raising rates and either pause or actually cut rates. And if that happens, like we said on the TNX chart, if rates go down, the price of the bond funds go up. So a lot of people are looking to be invested in bonds right now with the expectation that when the Fed pivots, bonds explode higher. Okay. In terms of this, and again, that's like prognostication, right? It hasn't happened yet. As of right now, the F fund, like all the other funds, is below that 20-week moving average line. So at some point, if what a lot of people think will happen, if it happens, we'll see it in the chart. Price will get above that 20-week moving average line, and that will be the time to get really, not necessarily get back into the F fund, but that's the time where the odds that it continues higher are the greatest. Okay. So hopefully that makes sense. If you guys have questions, please hit us up on all the socials. If you're looking for more kind of real-time analysis than what we just did on the 2-week charts, consider becoming a member of the site. Members get a weekly newsletter that goes into much more detail and a much shorter term analysis, right? They also get texts when we move our money, right? When the Conan and I move our personal money within our TSP accounts. And there's the live members-only webinar every month. We go over our performance versus the performance of the TSP funds, and we analyze the previous several alerts that we had put out. And then, of course, it's a webinar, so it's live, so we answer member questions live. So if you're interested in that level of analysis to help you manage your TSP, sign up at growmytsp.com. All right, that is all I got. We will see you guys back in the podcast studio next weekend. Have a great week.